This video is a Crypto.com exchange tutorial. So I'm going to show you how to get set up with an account, how to get some fiat currency into your account here, manage your wallets, trade both in the spot market and in the futures market, and then some of the other features like bots and staking. So the Crypto.com exchange is a much more professional trading system, and it's actually a different application than the Crypto.com app. You can see both of them here. So if you have a Crypto.com app account already, you can port your account over. You just download the exchange app, log in with your Crypto.com app details, and there you go. If you don't have any accounts yet, you can just sign up for one of these apps. And if it's available for you, you just go through, sign up for an account, do your KYC details, which is either a passport or an ID card to prove that it's you, and then you can go ahead and trade. So you can have both of them, or you can just have one of them if they're available for you. Now, the difference is the exchange app is much more professional features here for trading, and the trading fees are way cheaper. So if you can get the exchange app, I'd certainly recommend it over trading in the more retail friendly app, the Crypto.com app. So the exchange is the way to go if you can. Now, I've also got a link below to a 5% fee discount as well on your trading fees on the exchange app. So if you are signing up, check out that link below. After you've set up an account or you've just logged in with your existing details from the Crypto.com app, then we can go ahead and use the platform. So I'll show you on the desktop here. It's very similar on the phone app as well if you want to use that. But for right now, we're going to look into our settings. So top right hand corner, you should see some details right here. I'm going to go over to security first. I would put this on. So 2FA is two-factor authentication. Go and download Google Authenticator. It's completely free, and you can set it up right here. So this is a 6-digit code that refreshes every 30 seconds. As you can see, once you have this, you can change your account password and withdraw funds. So set that up, and every time you want to do something important, it's going to ask you for that code with Google Authenticator. Just make sure if you are setting up Google Authenticator and you haven't used it before, when you set up the Google Authenticator code, it's going to ask you to scan a QR code right here, and that links the Google Authenticator with this account and that 6-digit number. Now, that 6-digit number will also have a long code with numbers and letters. I would write that down and put it somewhere safe, because if you lose your device, for example, your phone that has Google Authenticator on it, then you're going to have to reset that with Crypto.com. However, if you get a new phone, you can actually reload the same Google Authenticator via that long code that you're given. And so it's just going to save a lot of hassles if you lose your device. Now we can set up our fiat currency deposit accounts. This is where we actually deposit fiat currency into to go ahead and trade for some cryptos. So on the left-hand side, you can see wallets. This is actually showing us our fiat currency and cryptocurrency balances. So USD and Euro, I've got those two options right here for me. Maybe a bit different for you depending where you live, but we can go ahead and actually make some deposits here. And on the right-hand corner as well, if you click this, you can see bank transfer. So I'm going to click that and show you this option. So I have Euro and USD. Euro via SEPA and USD via SWIFT. So as long as your bank uses those payment systems, you should be able to send these currencies into Crypto.com. So from here, I'm going to activate this. You can see USD not activated, so I'll activate this and then go ahead, accept the terms and conditions, so you can press accept. Now I have to give some extra information. So what this is going to be is proof of address details, right? So I need to prove that I live in the place that I've said I lived and that I am a resident of the country that I said that I lived in. Once you put this information in, you're going to have to prove it either with a bank statement or a utility bill or something like that. So you'll have to go and get that via a PDF or anything that's accepted and then upload it into Crypto.com. It might take them a while to actually accept this and make sure that you've proven you live where you say you live. Once they have this, they'll actually start and activate the account for you. And then you'll be given bank details. Then you can go over to your bank and get the bank details that they've given you, send in the USD or Euro or any other supported currency via the accepted payment system. So essentially this is just proving where you live, giving them some ID details, because if we're dealing with fiat currency, they have to do this. Once this is set up, you can just make the payment over from your bank into their bank details. The Crypto.com exchange allows us to trade with margin, which is where we borrow against the value of our assets. Then we have that borrowed money that we can trade with. We can use that to buy or sell assets. And then obviously you have to pay back the loan at some future date. And if you do borrow money, then obviously if you're losing, then that's going to be some leverage on your portfolio, right? So if you're borrowing money, you can either make losses or wins over and above what your actual assets are trading at. We'll get onto that in a second. We can also trade in derivatives markets with perpetual futures or just expiry date futures. Now, these are derivatives markets where you can use leverage. So what we can do is we can split up our accounts and create sub-accounts that segregate the risk of some of our trading positions. So you have a master account first, which is basically just everything, and you can just put it all in here. Or if you're taking out some leverage positions or margin loans and you want to segregate that from other assets, just come and create a different account. So in the top right, go to the option here, which is manage account. This comes down to account management. You have the master account here, which is the main one. Right here, as long as you've done your 2FA, you can turn this on and create a sub account. That can create a sub account where you can choose if it's for trading spot, margin, or derivatives, or anything else. And so if you have some risk that you want to segregate away from your other assets, just create a sub account and then you can do your trading in there. The Crypto.com exchange has much cheaper trading fees than the retail facing app. So if you can use the exchange, I would highly suggest it to save some fees right here. On the retail app, what happens essentially is they just give you a price for the crypto that you want to trade, and they don't charge a commission on top, but the price that you pay is much worse than the real traded price in the market, about 1% or so. So you're actually paying 1% in fees as a spread away from the real price. On Crypto.com exchange, it's a more professional setup where you get a real market with the real price, and then they charge you a commission on top. Now, these commissions are much lower. You can see that for me anyway, it's 15 basis points to 30 basis points if you're a maker or a taker. Maker, that's where you enter limit orders onto the book and show your order first and hope to get traded later. You pay lower fees. If you use market orders and take someone's liquidity out of the order book, you pay slightly higher fees. So 15 to 30 basis points is a starter. If your volume is higher, you start to get cheaper trading fees as well. Now, you can see the derivatives market, much cheaper fees overall. You can see 2 basis points to 4 basis points here. And you can also reduce your fees via locking up amounts of CRO. So you can see how much CRO you want to lock up. It's up to you whether you want to buy CRO. It is a risk asset, so it can go up and down as well. Just to save a little bit of fees, maybe not worth it, but it's up to you. You can also stake it for apparently 8% a year. So it's up to you if you want to try and reduce fees. It's all up to how much you're trading. Like I said, that link below gets 5% extra discount as well. So if you want to use that as well, you can get some cheaper fees. If you've got crypto on another platform already and you want to deposit it into the Crypto.com exchange, you can do that. If you've got crypto on your app account, the Crypto.com app, and you want to transfer that in, it's actually easy as well. And it's linked directly from your app account to the exchange account. So firstly, if you are transferring in an asset that you already have elsewhere, just go and search for it on the exchange and then press deposit. It's going to give you your crypto deposit address. Once you have that, just copy this in, go over to your other exchange, and you can transfer it in right here. Just make sure that the receiving blockchain and the blockchain you're sending from are the same. So for right here for Bitcoin, it's only allowing me to send Bitcoin over the Bitcoin blockchain. There are some others out there, some wrapped versions, but for this one, this is the real Bitcoin on the Bitcoin blockchain. So just deposit and withdraw on the same chain to this address. If you are sending in stablecoins, it's a little bit different. So Crypto.com exchange bundles up USDC, which is a stablecoin, and US dollar fiat currency into one asset, just known as USD. So when we trade in the spot market, you'll see some trading pairs, which are the crypto against USD. This could be either USDC or USD fiat currency. It's just bundled up. If you're using one of the other stablecoins, these have separate markets. So we can see USD here or USDT. I can just deposit that in, and I can deposit over a bunch of different networks, Ethereum, Solana, Optimism, Arbitrum, as you can see. So if you have USDC elsewhere, you want to transfer in, you can do that as well. But if you transfer in USDC, it's going to be bundled up on the platform and known as USD. If you have assets in your Crypto.com app account, so I've got some USD coin here, which is USDC. I'll press this. I've got a balance. I'm going to press transfer. I'm going to press withdraw. And then it shows me right here, Crypto.com exchange. So I'm going to press that. And then I can put an amount in that I send over, and then press deposit. That's going to link up the account, so I don't have to worry about anything. It'll just send over from the Crypto.com app over to my exchange account. If you do send crypto from your app account into your exchange account, that's an internal transfer, so it's basically free and instant. You can see it's ready to trade right now. We'll quickly look at staking though, if you do want to stake your assets. So usually with staking on the blockchain, you would have to buy the asset, withdraw it into your wallet, and then go ahead and stake it on the blockchain via a native wallet there. It's fairly complex. Some people want to do that, some people don't. So for Crypto.com, what they're doing is you're using them as a service to go ahead and stake on the blockchain. They're doing all of that stuff, and they're just passing the rewards back to you. I'm sure they're taking a small fee for that as well. But the rewards here are about what these assets pay. So the fee that they're taking probably isn't very big. In any case, for example, Ethereum, if you have some ETH in your account, go ahead and stake it. They'll go ahead and stake on the blockchain. You can see the unbonding period for this one is 10 days. So you stake it. If you want to unstake it again, you have to wait 10 days before you can trade it or sell it or send it out of your account. So that's what staking is. the lockup periods are different for all the blockchains, but you can use crypto.com for that. There is also an option to buy CDC ETH, which is crypto.com ETH. That's a liquid staking token. Too much for this video, but it's kind of an upgrade on staking where you can own the token, you can own the staking rewards, but then you can buy and sell the token and do what you want with it. So I'll leave it for videos linked below if you want to learn more about what liquid staking is. But I think it's a decent platform here for staking if you just have small amounts, you don't want to deal with wallets. It's up to the individual. Now we can go ahead and trade in the spot market on the crypto.com exchange, trade, spot. The spot market is cash settled, which means any trades in here are final and you own the assets that you trade. So if you want to buy some Bitcoin, you can do that and it's your property. You can withdraw it from the platform. If you want to sell a crypto to cash, you can do that. You can withdraw it to your bank account. So this is cash settled. And what we can do is change the layout. I've gone to the professional layout here. I've just left all these on and we can choose the trading pair that we want to look at. So in the top left, I've got the Bitcoin USD trading pair. Like I said, USD is USD Fiat and also USDC bundled together as one market. USDT, if you want to trade against that, that's a different market. And PayPal USD, that's a different market itself. So different liquidity, slightly different prices. So it's up to you what you want to trade and what you're comfortable with. I'll just choose Bitcoin USD here. And you can see my balances of these assets down in the bottom. So we have the chart. This is a TradingView chart. I would recommend going ahead and getting a TradingView account. It's completely free anyway. I'll link TradingView below. I use the pro version, but you don't need it. There is a free version that's awesome, and I highly recommend it just for extra charting features, but you can use it directly within crypto.com as well. And we have the order book here. So we have sellers up here, and we have buyers down here. These are buyers who are bidding for Bitcoin at these prices, and these are sellers offering out Bitcoin at higher prices. Whenever a buyer and a seller meet, this is the traded price, and that's that mid price here. So the last traded price will tick here, and you can see that. And obviously buyers are trying to buy a bit cheaper, and so these prices are all below the mid price. These sellers here are trying to sell higher, and so their prices are above the mid price. Anyone that meets, obviously that trade happens, and you can see that right in the middle. So we can join this order book as well. Now we'll look at using market orders and limit orders to go ahead and trade. So what we can do is on the right hand side, put in our orders. So you can choose between the buy side and the sell side. What do you want to do? Now this is the Bitcoin USD trading pair. So what that means is, if you see in the top left, Bitcoin is on the left hand side. So that is what we're going to be trading. And we're quoting that currency in the USD on the right hand side. So this currency is the one we're trading, and we're quoting that currency in the amount of USD that it takes to buy 1 unit. 1 unit of Bitcoin is 1 Bitcoin, but we can trade any fraction. So essentially, Bitcoin is a unit. How many of this USD does it take to go ahead and buy 1 unit of BTC? And what is the price? Well, it's this price right here, right? 72,283. So we can trade any fraction of a Bitcoin if we want. So the first thing we can do is go to market order. This is where you don't choose the price that you pay, but you choose a quantity that you buy. So if my order value right here is, let's say, $50, what that means is I'm going to spend $50 and I'm going to buy some amount of Bitcoin. I don't know the exact amount because I don't know the exact price that I'm going to trade at. What I'm doing here is essentially saying, just go and buy $50, and it's going to look on the order book and it's going to find the cheapest offer that I can buy at. And that's obviously this one down here. That's the cheapest offer. You can see it's just 1 penny above the best bid. So I'm going to take this one if I want to buy it, and it's going to take that order and it's going to give it to me. I pay taker fees, trading fees on that occasion, which, as you've seen previously in the video, taker fees can be slightly higher than maker fees. So if you want to get your order done immediately, just do that. It's easy to press buy BTC, you've bought it straight away. We can also use a limit order. Limit orders are where we choose the price that we pay. So what I'm going to do is put a limit order in. My limit price, I want to choose as 70,000, and I'm going to choose an amount of BTC that I want to buy, let's say $50 worth. Now it can work out from the order value and the price what the quantity would be, and so I can put that order in. Now notice that my price that I want to pay is below what the market is paying. These guys are actually bidding way higher than me. They're bidding 72,300. So I'm not going to trade here because my limit order is too cheap. What I'm telling the system is buy Bitcoin immediately for me as long as the price is 70,000 or below. Well, it isn't. So what's going to happen? Well, what will happen is that the order system, or the trading system, will put my order on the book and it will work it for me until the price gets down there, or if it never gets there, it will never trade. You can see here, GTC, This means good till cancelled. So it means my order that I'm about to put in will be good till cancelled, till I cancel it. And it'll just work there forever until I physically cancel it. FOK is fill or kill, which means you need to fill the whole order. And if you can't do that, then just cancel the whole order, right? So what that means is essentially the volume that I'm trading. If my price and volume cannot be matched, then kill the order, right? So I don't want to trade a small amount and then work the order. I just want to have it all or kill the order. Immediate or cancel, again, if you can't do the order immediately. So if I put this in at 70,000 and pressed immediate or cancel, I can't fill the order and therefore the order will be cancelled. So I'm good for GTC because I want to show you. So buy Bitcoin. That should go through, order submitted, and we have an open order down here now, and you can see that. So the time and date, I'm a limit order, buy side, my price is 70K, this is how much I want to buy, and my limit price. So my order is open, and obviously it hasn't triggered or it hasn't gone through yet. So just below my head, you should see an action button, and there's a red cancel. So I'm going to cancel this, and that's cancelled now. So I put the order in, it didn't get done, but I canceled the order out, and so we've now got no order in. A key tip here with using limit orders, and I would use limit orders, is just to bid slightly below the current market price. Because when you're trading a market order, you're paying slightly higher trading fees, and you're paying this price right up here. And the price of an asset always bounces around a little bit. So what I usually do is just go and press down here on the order book. You can press this to populate the price, choose the amount that you want to go ahead and trade. And what you can do is wait a little bit for that price to trade. So what we can see is that because I press this, it was around 284, right? So I actually would have traded there at 284. So you can see the price moves around. So if you always just put your limit order a little bit below the current price, it'll probably go ahead and trade at some point. It's just making a little bit more than just paying up those trading fees and paying the market orders. So you can do that right here. You can also make sure that your order goes in as a limit order and not a market order. So for example, if my limit price was 80,000 and the current price is 72, I'm going to trade immediately, right? Because I've told the system, trade immediately as long as the price is better than 80,000, where it is. This actually turns a limit order essentially into a market order because you're going to trade immediately. So you're going to pay taker fees because you're using a market order basically, and you're going to pay, you pay up, right? So what you can do is actually put post only. And what this does is prevents you from turning a limit order into a market order. Right, so what this does essentially, it says, wait, your limit is 80,000, it's going to trade immediately, and post only means you don't want to do that. You only want to post the order as a limit order, and it won't get done immediately. So if you make a mistake, this is like insurance to say you're not going to put a crazy order in, right? So that's up to you how you want to actually enter your limit orders. There's a few other different order types as well on the crypto.com exchange. So the first one is a stop loss. A stop loss is where you put in an order to actually take a loss on your trade. And it's known as a stop loss because it prevents any further losses. So it's kind of like a way to get out of your trade at a small loss via preventing much further losses if the asset falls further below that. So you have stop loss market and stop loss limit. Both of these are the same. What they do is sell either with a market order or a limit order. So if you have stop loss market, what you do here is you enter and tell the system what you want to do. So what you're doing is we're going to sell. Stop losses are usually on the sell side. So you have an asset, you have an amount of the asset. Let's say we bought at 72 and we want to take a loss at 62 if the price goes down here because we don't want it to go lower and make a further loss. So you buy the asset, you have the asset here, and then you would sell with a trigger order right here as a stop loss. So what we're doing is stopping any further losses. The reason we need to use a separate order here is because if you wanted to sell at 62,000 and use a limit order, it's going to trade immediately for you because what you're saying is sell immediately as long as the price is 62,000 or better and the current price is better than that. So it's actually going to sell immediately. Sometimes you don't want to do that. You actually want to sell, you actually want to give the trade a bit of room and sell lower at a loss, right? But you need to use a separate type of order, which is the trigger order. The trigger order essentially is a way of putting in the order at that trigger price only. So if my trigger order is 62,000, what I'm doing here, if we go through this, I'm telling the system, sell, enter a sell order at 62,000 only, and the quantity is whatever, right? And that's a market order. So what I'm doing here is saying only if the price of Bitcoin gets to 62,000, then that is the trigger that then enters my sell order to sell 0.01 BTC at market as a market order. So the market order only enters at this trigger price. You can also press stop loss limit. And again, this enters a limit order only at the trigger price that you set. So sell, enter a sell limit order for me at 62,000. And I want my limit price to be 60,000. And I want you to trade 0.1 BTC. So what this does is only when the trigger price is met at 62, you then enter a sell order with a limit price of 60. Now, if the price is 62 and your trigger order enters with a limit price of 60, the price is going to be 62 because that's the trigger being hit. So you'll get the order done, right? If you put in a limit order of 70,000, you actually won't trade here. Your order will go in because the trigger price has been met at 62. That triggered the limit order to be in, but your limit order is 70, the price is now 62. So you won't actually trade, but your order will be in the system. So this is a trigger order. You only enter an order when the trigger is met. We can use this exact same order type on the other side of things if we want to sell at a higher price as well. So you can actually have a take profit. So we can put take profit limit and take profit market, which is essentially the same thing. So it's a trigger. So the trigger order is 100,000. Put my limit order in at 100,000 and the press quantity. Now, there's no real reason for this order actually, because for this, if you do have Bitcoin and you want to sell higher, you can just use a limit order, right? Because the price is 72, your limit order is 100, that makes sense to sell. So this take profit limit is in here. It's not going to be useful if you actually have the asset and you want to sell higher, right? Now, if you do want to enter a sell order here, take profit limit. So if you actually have a sell order in, so if you're using margin, right, and you're borrowing assets against what you have, and you're actually going short the asset, which you can do, right? So you can borrow some assets, and then let's say you borrow some Bitcoin, you have, let's say, 1 BTC in your account. You can actually borrow another half a Bitcoin. That you have half a Bitcoin borrowed, you can actually sell the Bitcoin. So you can sell that half a Bitcoin that you borrowed, and you've sold that Bitcoin up here, and you obviously want to take profits by buying it back lower. Now you can do that by buying. So you can actually put that take profit in. So you've gone short the asset, you've sold the asset on loan or margin, and what you can do is go ahead, sell it, and then your take profit would be buying it back lower. Again, you wouldn't want to use a limit order on that occasion. So the take profit, let's say you sold at 72 and you want to buy back at 60, right? 60,000 trigger, 60,000 limit, the amount of Bitcoin that you want to trade, and then you'd go ahead and trade that. So that's for margin trading. If you are loaning assets and borrowing assets as well, you can use those limit orders for more active trading and for margin trading. If you're just trading in the spot market and you're buying and cash settling, it's really just buy and sell with limit orders, I think makes sense. If you do want to put a stop loss in for some of your trades, you can do that as well. Now we'll look at the bot platform on the crypto.com exchange. There are a few good ones here. DCA bot, dollar cost average bot. So we can go and just automate daily or weekly purchases for the assets we want to trade. So for Bitcoin, as an example, create now, we can buy Bitcoin once a week for 6 months, and the total investment, $1,000. That will split that $1,000 up against once a week for 6 months, or you can do per order, maybe $100 an order. You can proceed with that. It's just going to automate that for you. It might be easier than just doing it manually, but that's up to you. We also have TWAP bots. This lets you actually trade orders over time. Now, this is good if you're trading much larger orders. Let's say you want to split up the order over a day or a couple of days. What you can do is enter the order over those couple of days and get a decent average price compared to what the market actually traded. Time weighted average price, TWAP, right? And so what it's going to do, it's going to take time, and it's just going to kind of drip in your order over that time and just even out. Now, you may not outperform, right? This is down to what price you buy. So it may have been better to just buy everything all at once on Monday because that was the cheapest price. But, you don't know, right? So maybe Tuesday and Wednesday, price goes up, and then Thursday, the price comes back down. And so your average order may be a bit lower. We don't really know, but this is a bot you can use. So we want to buy USD, market order, that's fine. So you're going to be paying slightly higher trading fees if you do that. The quantity of BTC, so if we're trading a bigger order like 5 Bitcoin, duration, 24 hours, or you can put the custom duration in here, press proceed. So what you're just saying is, look, I've got 5 Bitcoin, or I've got 5 Bitcoin to buy if you want to sell it, right? Work that order over 3 days. and it's going to give you a weighted price, the time weighted average price of what was traded in the market. Now an overview of trading futures on the crypto.com exchange. Now there are futures and there are perpetuals, and we can trade both of these on the exchange. Trade perpetual futures right here. What's the difference? Futures have an expiry date. So what these are futures contracts. We're now trading derivatives. We're not buying and settling the assets. What we're doing is using dollars to fund trades and positions on the price. So we can trade the price long or short, meaning if we go long, we hope that the price goes up from when we buy to when we sell. If you go short, what you're doing is taking a sell order first, selling it, and then hoping for the price to fall. So you buy back lower and you make the profit on that. So you buy low and sell high, but you can either buy low first or you can sell high first, going long and short. We do not buy and hold crypto. All we're doing is taking a position against another market trader on the price that's going to be traded in the future. That's why they're known as futures. Futures, if I click this, these have an expiry date and you can see them in the top left. So we will have expiries and you can just see the date format here, right? So 2024, 11/29, and then into the future, you have 2025, 03/28, 28th of March, all right? And you have these expiries. So essentially, what does this let us do? It lets us take a position on what the price may be in the future. So let's say the future right now is trading at 75,743, and we think that by March 25, the price is going to be over 100K. When you buy these 75 futures, you'd wait until the price hopefully goes higher and closer to the date. And if it is, then that price is going to move up. And what you can do is close the position and close the trade and you make a profit. Now, if that doesn't work and you buy 75s and it comes down to 60, you have the loss to pay. And the way that you pay that is through dollars. Everything is traded through dollars. So we have Bitcoin USD right here. What we're doing is funding our account with dollars to pay for any potential losses. When the trade closes, we exchange the profit or the loss. We don't exchange any crypto at all. We're just trading the price and making profit or loss on the price. The big difference between crypto perpetuals and crypto futures is what's known as the funding rate. In crypto futures with an expiry date, there is no funding that is paid. You just open the position and you make your win or your loss. With perpetual futures, these actually have something known as a funding. And that is because there is no expiry date to this futures contract. It goes on forever. And that means there can be wild differences in the price of this thing versus the underlying spot price. Because we're trading a Bitcoin USD pair, this price must reflect the underlying spot price. Otherwise, it's just completely out of whack and no one can trade that market. So what happens is that there is a funding rate, and you can see the funding rate up here, current funding and next funding. This is basically a fee or an incentive to try and make sure that traders are pushing and pulling this price around to be exactly the same as the spot price, more or less. And the way they do that is through this incentive. So if buyers are coming into the market, in the futures market, and pushing this price higher than the spot price, there's a difference there. And what they do is they have to pay a positive funding rate. They essentially pay a fee for pushing the price too high. And this funding rate is an incentive to short sellers to come in and sell and bring the price back down to what the price should be. So if this futures price is above the spot price, longs will pay this funding rate. You can see this funding, I think it's exchanged every 8 hours or so. You can see the countdown here. And if you are long and the price is positive, is a positive funding rate, you have to pay this out to short sellers. So it's a cost that you're going to pay. The longer you have this open, the more you're going to pay potentially. Now, the other side of that is that if sellers are coming in and forcing the price lower than the spot price, then that means that this price is too low and the exchange is going to incentivize longs to come in and try and push the price back up. And on that occasion, sellers would be paying this funding, buyers would be receiving the funding. So it's a fee to try and keep the price in line with the spot price. Sometimes it's positive, sometimes it's negative, but it is a fee that you need to make sure you know about when taking positions. Usually comes out around 10% a year. So it's not a big deal, to be honest, if you have an account open for a trade open for a little while, but it's something to be aware of. And it can rack up if you have big positions over long periods of time. So it's something to be aware of. If you don't want that, you can trade perpetuals. You can trade futures, sorry. The only downside here is that you do have expiry dates that you have to be aware of. The other thing with trading derivatives is that we can trade with leverage. The exchange gives us this leverage because, again, we aren't actually trading crypto here. We're just taking a long or a short trade. And we have collateral on the system in dollars, you can see that here, to pay for any potential losses, and that's it. So the reason you can trade with leverage, so let's trade this at 10x leverage. What does that mean? Let's say I have $1,000 on the platform. It means I can take 10x leverage on that and I can open a trade worth $10,000 in the market. The reason I can do that is because we're just trading paper. We're just trading derivatives of the underlying crypto. And as long as we can pay for our losses, we can open any size trade that we want. It doesn't matter. So we have $1,000 on the platform, we open a $10,000 position. So if that $10,000 position moves 10% down, that wipes off $1,000 of equity out of our account. We have $1,000, we get liquidated because the exchange will not let us have a bad debt. So as soon as we lose 1,000, we pay that 1,000, we're out. So a 10% move is a huge downside move for our initial capital. On the other side, if you have a $10,000 position and it goes up 10%, you make $1,000, you've doubled your money from what you put into the trade. Now, that's leverage. So it makes your wins and losses bigger and faster for sure. And so it's only really for professionals, for more advanced traders who also know that these things can move south and you can lose a lot of money very quickly. So I can't recommend leverage, but that is why they let you trade with it. It's because we're only paying for potential losses with our collateral. The exchange uses cross margin for each of our accounts, which means we have a dollar balance in here as margin, as leverage that we can trade with. And then any positions are just going to be using that margin. Now, if you want to segregate positions so that if one blows up, it's not going to use the margin for other trading positions, you may need separate accounts. Like at the start of this video, you can trade with different accounts there, segregate your positions. But if you are trading within one account, it's going to use your margin across all of your positions. So just to show you here, I'll use 10x leverage and I can open a $1,000 position. Right now, the initial margin I put down is $20. So you put that down into the trader's margin first, but I have almost $200 as leverage here. So what that means is this $1,000 position, I've got $200 to pay for any potential losses. So this can move 20% to the downside and I'm fine, right? So that's how you have to think about this. So if we go long, you can actually see this. I'm going to open a $1,000 order value in the market, but I've only got $200 as a wallet balance here to pay for losses. So this thing can fall 20%. So if I press confirm, should open the order for me. Order submitted. It's a market order. There it is. So I'm long and I've got some wallet balances here. So my unrealized P&L is 7 cents underwater. Margin balance, as you can see here, the available margin is 172 because I've got that initial margin tied up. Right, so this position, initial margin's $20. My effective leverage is only 5x. Why? Well, because I have $200 in, I'm using 10x leverage. So, if I had $100 in here and used 10x leverage for a $1,000 position, that would be 10x. But I've got $200 in my account to pay for this $1,000 position. So effective leverage on the whole entire account is 5x. Right, so I have that position and that is leveraged upon what I actually have. I only got $200 in, I'm using a $1,000 long position right here. Now, if I want to reduce this leverage, I just go and get dollars and I put it in this account. And those dollars are now there to reduce the leverage I'm taking. So if I go and put $800 in the account, my effective leverage from my account's basically going to be zero because I've got a $1,000 position and I can pay for that $1,000 position, right? So the amount of volatility in the price that I can handle then goes to almost the whole thing, right? If this falls 20%, I get liquidated. If I put $1,000 in here to pay, the thing can fall to zero and I've got the cash to pay for it. So that is what that effective margin is. And you can see the margin balance and what you've got tied up in here. Now, if I go and enter other long positions, so if I now go and enter another long with $1,000, I'm actually increasing my leverage up to effectively 10x. So $2,000 position with $200 to pay for it. So that is how margin works here. You just have to look at your initial margin and your kind of effective wallet balance here, because if you now move into profits, then what's going to be happening is you have unrealized profits in your trades and your effective leverage is going to be going down even further because you've got equity in your account from those trades now. So that is how you would go long. Now, if you want to get out of the position, you can do. Just under my head, it says close position. And we've got this here. Now I can close with a limit. I can choose the price or I can choose a market order to just get out of this position, which I will do. So press confirm and then the order will cancel out. So you just have to be aware of exactly how much margin that you're using, right? So how big is your order value compared to how much you've got in your account to actually go ahead and pay for it. Now, that also goes into risk management. So if you know what your order position is and a potential stop loss that you have in, you can work out how much risk you can take. It's too much for this video. I'll leave some videos below on that, which go through exactly how to think about leverage and how big your position sizes should be compared to what your portfolio is. Some free videos down below on that. The Crypto Investor course has entire sections on this as well that go through that step by step, and private Discord groups if you want to ask me questions in there. I'll link it below as well. There is also a 5% fee discount to the Crypto.com exchange if you haven't got an account yet and you're signing up, down in the description. I'm James, it's ManZG. Cheers for watching, and I'll see you in the next one.